Good morning, ladies and gentlemen. Well, the risk dial was right all week. On Wednesday, it went to the highest reading we had for this whole rally since the 3200 region, and since it turned positive, and the market has not looked back. It broke every single resistance and is now on its way higher. You can see here that on Tuesday it fell very little, on Wednesday it went to new highs, and on Friday it closed at the highs. From a weekly perspective, we are now very much in an ascending trend, and the moving averages are moving far apart with the higher scores. It is unlikely that we will see the market coming back. I would have thought that these moving averages will now go up towards the 100 mark, and basically the odds are that we continue up higher, and that is what the Bristol is saying. Well, there can now be no doubt that the yield curve in the US is normalizing. 2s10s are slightly going out. I would be very surprised to see it break this 74-75 area. I don't think there's a chance in hell that it does it in the next few weeks, certainly not before the election. And that is bringing stability to the whole yield curve. I think now we're in a range between this 53 area up towards the 70-71 area, and that is really all that the equities need, that the risk markets need to start pushing higher, is if you have stability in the bond market, and if you have the 30s and the 10s contained in a small range, anchored by the 2s and the 5s, that enables the continuation of a risk-on trend. I really would probably like to be short around the 70 area. I think that, as you will see in a moment, the 30s have probably done everything they're going to do before the election, and that is actually adding fuel to the fire of chasing yield in risk. Another very interesting tell is how the European markets just do not want to know about going higher in yield. This is the bubble, the 5-year. You can see absolutely stable, and in fact, with a tendency to go down in yield. This one is the 10-year, the Bund, pardon me. Absolutely no intention of going higher in yield. I think even the odds are that we go and test the 60 level, again minus 60 level at some stage, but this stability here is actually causing the break higher in from 125 in the differential between the 10-year note and the Bund. And odds are that we stabilize here around this 138 level now. So it looks like we have very little upside to go in the 10-year, and certainly none in the Bund. This differential is still going out slightly, but I think that it is more likely than not now. I mean, the odds really are overwhelming that we have done 90% of the steepening that we're going to do in the yield curve in the US, and that we are going to regain stability in the long end, which is actually going to pour fire onto the risk rally. Just so that you understand exactly what I'm saying, let's have a look at the 30s. Basically, they just can't break this 163 region. Every time you get there, you have big bids in ultras and in 30s. It seems quite logical to me now that we will hug this descending 200-day moving average over the course of the next week, so the odds are greater that we have a little bit of a rally in the futures in the 30s rather than a continuation up. Basically what is happening is the 2s and 5s are getting to levels where they really don't want to know about going higher. The Fed has been very clear about its intentions, and what the longer end is saying is that, okay, what are the odds of this inflation actually developing that you want? And at the moment they are not that great. And basically the yield curve is going as steep as it can for the time being. That to me tells me that the risk reward is actually for a move back down towards the 145 area in the 30-year, and we can actually have a look at the curve and what that implies. On this chart of the 5s 30s, I've actually changed this time frame to a daily, and you can see basically how we tried the downside, failed, tried again, failed. I think now the odds are that we have stability between this 120 and 123 area. So basically we've taken the curve, it looks like, as far as it wants to go for the time being. The uncertainty is still there, but it's just not pushing the way I thought it would push once it broke these lows. This low was significant, we broke it, we came back, now we've broken it again, but we are just trading around this level. It seems this is about as far as the yield curve can go before we get some certainty. I'm sure it'll go a little bit steeper if we get a big package of aid, and I'm sure that it'll get a little bit steeper if we get a democratic clean sweep, but we're talking about basis points. Okay, so what I've been saying all along is that if the yield curve is contained, if the 5s 30s are contained to that 140 level that is so important below here, then I really don't see it as a risk-off potential, and basically the stability of the yield curve is now going to force people into more risk and into equity. To see graphically what I mean, all you have to do is look at SPY IEF or SPY TLT. If TLT and IEF are now stable, we really don't need a lot of movement out of SPY for this chart to improve and even stay around these levels. Very small improvements in SPY are going to be enough, and that is probably what we are going to get. We are going to get a continuation of this risk-on move, with smaller movements in SPY being enough to hold us up around these levels. And I do think that we are likely to go into the election at these moving averages. That is what the market tends to do. Before big events, it tends to concentrate around the longer term moving averages and not be at one extreme or the other, because then it could really have a violent reaction one way or another, and people prefer to be invested around longer term averages so that the potential surprise is as small as possible. Another surprise is what the market didn't do last week, and what markets don't do are as much of a tell as what they do. The dollar basically did not look bid all week. It just looked offered, and it could not make any gains despite the fact that interest rate differentials between Europe and the US were going out. That is a bit of a tell. It is looking worse and worse. The fact that we can't get towards the 95 area, which is a great risk reward, tells me that the market is just not bid, and really it also tells me that the danger is now, very much turning to the downside. You can see on these weekly moving averages how we are rolling over in every single, from the moving average from the longest to the shortest, and basically the 200-day moving average is well and truly on its way down on the dailies. This trend line, which goes back for all the way back into the early 2000s, is very much in danger of being broken to the downside. I think that the danger in the dollar is all to the downside at the moment, and that is what a Biden victory would result in. It would result in more printing, and it would result in probably more QE, all things that are going to keep the bond market at the longer end, probably no, in a smaller range, probably with still a bit of a tightening, steepening bias, but not very much. It looks like we have done most of the steepening. It looks like we're reaching the stability in the longer end, and if that is the case, we are just going to be printing more and more dollars, in which case the dollar starts going down. It looks like that is what the DXY is saying. The odds are shifting very rapidly towards a lower dollar, and once it starts breaking this trend line here, I think you probably get an acceleration all the way down towards the 88 level. If I'm correct, and it's still a big if, that the yield curve has probably done 99% of what it's going to do, and it's going to be roughly stable, and that the danger in the dollar is now turning to the downside, then gold would be a natural beneficiary. What is actually quite telling is that it got to my objective, the 1860, and it just stopped there and has not basically done very much. It is just retracing up with the dollar and with the stability in bonds. It needs to basically break these levels around the 1960, 1970 area, where we've had so many highs before, all the way up to 1980. It needs to clear them convincingly. What I'm saying is that basically it has an opportunity. It's done a little ABC retracement. It's basically retraced the minimum you would expect from this move down from the 1500s up to over 2000. So if it wants, it has an opportunity to go to new highs. The likelihood of it going to new highs is getting higher as opposed to lower. So I am beginning to like gold. I still have my position from 1860 down here. I will now hold it, just flat stop it, and probably use any dip towards that region to increase the position via options. It seems it has an opportunity. We have to give it the benefit of the doubt. If the yield curve has stopped moving, and if the US dollar has a greater chance of going down than going up, I think gold can only have one impulsive direction, and that is still up. Turning on to risk, it's been a long time since the price picture has been this clear. The transports, new all-time highs. All week they've just been doing better and better and better. They couldn't care less about Trump tweets or anything like that. We have a technical turn in the MACD in both the transports and the Dow. So as far as Dow theory is concerned, we are going up. The big gainer for the week was, of course, the Russell. together with the transports. You can see how it's respected this 1645 level. It got right to it and backed off, helped by these weekly Bollingers. Unlikely that we go much higher next week, but just maintaining this position up here is going to be bullish for the longer term. It's going to take several weeks for these Bollinger Bands to start opening up, but if we just maintain these levels, they're going to open up quite quickly, and then one of these weeks we're going to see a move up towards 1800, and take out all these all-time highs in the rut. Pretty clear to me that the odds of the RUT now coming back down to 1500 are very low. It's more likely to just do small weeks inside and then move higher. This chart is also very telling for me. I now have absolutely nothing trapped, no price boxes trapped. As long as we stay above this 34.28 to 29 area here, there is nobody who is in big, who is underwater apart from these guys here, and these guys here, they puked it. Okay, there's absolutely no way that anybody who is worried or who is trading or who is not a very long term guy who basically doesn't care less what price is at any given time, there's no way that these guys held out during this period, so they're out. These guys here and these guys here were the worry. Well, we've cleared it. Unless we start breaking below 34.28, I think the odds are that we take out these highs, not next week, but in the weeks ahead for sure. And volatility is saying much the same story. It had an opportunity, especially in the Nasdaq volatility, to go up towards this 40 level. It rejected it completely, and it's now likely to congregate around this 30 level, while the VIX could actually go below 2250, and basically put pressure on anyone and everyone who is long of it. I don't think that we go massively lower, but it's not giving me the look that it's worried about too much. And if it's not worried about a period like the elections, and that everyone is saying is going to be so volatile, then the markets are likely to surprise on the upside, not the downside. The market that surprised me the most last week, because it has had a wonderful opportunity to go lower, is actually the Nasdaq. It had the opportunity to go lower on a relative basis, but also on an absolute basis, and it took neither. This look here was ready to basically come down and do another leg lower down towards this 10,300 level. Completely rejected it. We stayed within the 10,270 to 11,566 area all week, and then on Friday, boom, higher. Now we have nothing really till 11,840, and when we bust through that, I think the odds are that we go and fill this gap, which is all the way up to 12,300. So really I can't see even what was the weaker sector not giving us some strength. It really it is far stronger than I thought it would be, and really it's all I can say is that if even what should be the weaker sector is as strong as it is, then there is not much hope for the downside for the time being. And here you can see it all week. The tech sector had the opportunity to move lower on a spread against everything, XLF, XLV, XLI. the Qs against the SPYs, the NDX against the SPY, the Qs against the IWM, and the only real chance that it took was against IWM, where it came down a lot last week. But against everything else, it had the exact same opportunity and it didn't take it. It basically ended the week flat, and it had an open goal and it didn't take it. That to me says that the danger is shifting back to the upside in tech, that the underperformance in tech is more or less done, and it's ready to resume leadership at some stage. Maybe not next week, maybe not the week after, but I think if it wanted to take the opportunity, it would have done it by now, I think. I think Biden, or whatever it is that Biden is supposed to do to tech, I think the move down in tech from over 12,000 down has actually probably taken out 99% of the worries. The market that actually impressed me most last week was EEM. Absolutely no retracement whatsoever, looking to get it down towards this 42 area to buy it. Absolutely no compunction with closing at new move highs above 45, and you can see how important 45 has been for decades. It goes all the way back to the 2000s. What can I say? I like EEM. It's a market that makes sense to belong of to me. I think the objective now has to be this 4790s area where we had so many highs before. And that is, if that is that's a 10% move higher. If that happens, what are the odds of the US not being up, 7 or 8%? Not very high. If I look at the ratio between the EM and the SPY, it's not telling me that SPY is about to collapse. And the fact that EM is so strong, I would have thought we could easily get up here to 47 something. That tells me that all the other charts are looking supportive. Whatever you look at, even if you look at something which is relatively weak like the DAX, the fact that we have been basically in a very small range gives me the opportunity to think that we are moving towards the 13,500 area in DAX, and then further on, if we look at Nikkei, which has also been doing very well, you can see how it basically is consolidating at these higher levels, waiting to turn the weekly Bollingers to start going higher. Everything we look at is basically saying that risk off is unlikely to happen for quite some time. One last chart that might be of interest to you who are slightly longer term thinkers. This is EM over FEZ, so over developed Europe, as it were. It makes sense. You can see how it's at a very, very important inflection level. It does make sense to me that over the course of the next few months, as a vaccine is discovered, the market that should rally the most is EEM. And if we start closing above this 122 level, I think we are likely to see it somewhere around here, 139, 140. And that is, that's a double-digit move in percentage terms. So that is what, and that's relative to Europe. So it's just telling me that EEM has huge potential over the course of the next few months, and that one definitely should not fade it on the upside. EEM over SPY is nowhere near as bullish as against FEZ, but what is impressing me is if you think about the fact that this is more or less this area here in February, January, February, March, is when the Fed basically came in and did this huge rescue operation of the US. Where are we? We're not really anywhere much below it. So if 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 the differential between SPY and EEM is so small, given the scale of what the Fed has done, the performance differential is so small, I think EEM is likely to keep up with SPY, or very close to it. In which case, I really think that the risk reward factor is actually on the side of EEM, and I'm getting more and more bullish of EEM relative to everything, because I think it's that the risk of it going down are less than anything else. In conclusion, what does all this mean? It basically means that I think the 2s, 10s, 5s, 30s have basically done as much as they're going to do before the election, that we are entering a period of stability in the bond market, and that is going to enable us to do slightly better in all the risk categories. If the dollar is looking weaker and weaker, gold has an opportunity to do better and better, given that these are going to remain stable. If that is so, this 1960-1970 area should be tested, and gold has a developing more and more odds of doing better longer term. It's as simple as that. I don't think 1860 will be seen again. If it is, I'm going to load up with call options and see what happens. I think SPX and NQ, we are now basically, unless we take out this 34.28 support and we bust 34.93, we have nothing but air above, and we're looking towards the 35.60 area and the 12,300 area in NQ. There's every opportunity that it had last week it didn't take to go down. Why should it do so now? I don't know. And this all makes me bullish of EEM. If these markets are basically stable and the DXY can go down, I think the logical conclusion is that EEM outperforms, and having broken out on a weekly close above 45, there's very, very little resistance up to 47.90. Thank you very much indeed, and tweet you on Monday.